This is Jim Willis, editor of Marcellus Drilling News and a member of the Intelligence Press Advisory Board. Intelligence Press is better known as Natural Gas Intelligence, or NGI. I'm talking today with NGI's Director of Strategy and Research, Patrick Rao. Pat has just authored a new special report on natural gas prices. Pat, what can you tell us about this new report?
Thanks, Jim. In this new report, we discuss the impacts of different supply and demand factors over both the short and long term, how those factors have and we believe will influence prices for natural gas in the United States. Now, it's important to say right up front that we are not providing a specific forecast for future natural gas prices. Rather, our objective with this report is to highlight and discuss which factors likely will be the most influential in moving gas prices in the near term and longer terms.
Well, let's dive right into it, Pat. Can you give us a few highlights?
Sure. We start the report with an overview of U.S. consumption and production trends over the last decade. While U.S. consumption has grown at a 2.0% pace per year since 2006, U.S. production has grown at an annual 4.5% rate over that time period, led by a surge in unconventional production. Now, gas production so greatly outpacing consumption over time is bound to take a toll on prices, and that's exactly what has happened in the U.S., although prices have rebounded somewhat recently. The United States traditionally has needed to import natural gas to make up for its annual production deficit, but that deficit has been shrinking in recent years and was almost non-existent in 2011.
Pat, do you think that the current price weakness that we see in the market today will continue over the next year or so?
Well, again, we don't provide a price forecast per se, but we do talk about how supply and demand fundamentals are shaping up for the rest of 2012. We believe one of the key factors that impact U.S. short-term gas prices is natural gas storage levels, which we discussed in detail in the report. And this chart here is a summary of that discussion. We believe storage levels will continue to decline because of higher natural gas use for power generation and lower second half 2012 natural gas production. If storage levels do decline, we believe it sets the stage for winter prices to possibly go higher. Incidentally, we base our expectation for lower second half 2012 U.S. natural gas production on the rolled-up production guidance of more than 150 U.S. E&P companies, so our production forecast is coming straight from the horse's mouth, so to speak. We cover all the key factors in the report: excess storage, the trend from coal to gas and electricity generation, rig counts, and even the weather, and we give you our best guess as to where the fundamentals suggest prices could be headed for the rest of this year.
Well, what about the longer term, Pat?
Well, we believe supply fundamentals will be the main driver for long-term prices, and we cover that in quite a bit of detail, including a discussion of the required long-term economic natural gas break-even price in the United States. We also discuss long-term demand drivers, such as those listed here. There's simply too much to talk about on such a short video, Jim, so I'd encourage viewers to grab the report for the full story.
And that's a great segue, Pat. The report does go into much more detail. You can get it absolutely free by going to the URL on the screen, which is research.intelligencepress.com/price report. Thanks for the quick overview, Pat.
You're very welcome, Jim.
This is Jim Willis on behalf of NGI. Thanks for watching.